I would like our panel to introduce themselves. We are the secondaries panel, and this will be focused mostly on venture secondaries. Secondaries is a huge market, covers a lot of private asset classes. And because we're limited on time and have a lot of questions, Dave, you are up first to give everyone with your background.
Hi, I'm Dave. I'm a nerd. Been in Valley for 30 years or so. Been a software developer, been a very small time entrepreneur, exit for less than $1 million. What a shitty entrepreneur I was. Worked at PayPal for a few years with some really famous people, and I've got a little bit of knowledge there. Worked with Peter Thiel and John Parker at Founders Fund for a few years, invested in some great companies with low prices, 2008 to 10. Started a company called 500 Startups, which was a little insane, and did 1,800 investments while I was there. In 70 countries around the world, had 20 people, people in 20 countries around the world. They've since doubled that, I think, since I left. These days I do something really boring called practical venture capital, because it isn't. And we buy secondaries, mostly at the fund level, but also directs.
I'm Laura. I have also been in Silicon Valley for about 30 years, but I'm originally from Chicago. I have spent my career in operating in tech roles in big and small companies. I've shipped about a dozen products at Silicon Graphics in its heyday. I run corp dev in public and in private companies, and spent a long time in venture. I also ran innovation at a really large bank, Royal Bank of Canada, and I serve on the board of the Canadian Bureau Bank of Commerce's U.S. board, and on a couple of private boards. I am launching a fund focused on venture secondaries with a partner. My partner ran half of AI for Adobe, and previously was #2 in AI at LinkedIn. That's important for our strategy, and I'll turn it over.
Thanks a lot. Good afternoon, everybody. My name is Raj Kolamudi. I am a founder and partner at a firm called One Prime Capital. We are a firm dedicated to investing in technology secondaries, secondary directs, as Dave mentioned. We're on our third fund. I've been a venture capitalist since 2000 for the first part of the primary side. Now on this.
There's more. You didn't mention the or all right. He's gonna, okay, you hold on to that for right now. Okay, I'm actually going to ask the panel a predicate question before we get into secondaries venture capital universe, which is, and I'm both like, by the way, this is a powerhouse panel. My wife watches Stephanopoulos every Sunday, and he has his powerhouse panel on politics. This is your powerhouse panel on secondaries, trust me. Because they've been through 3 market cycles like I have, and I think that matters.
This means we've had some pain.
It also means we're over 40.
It also means we see the board like a chessboard and not like checkers players, and I think that's important too. So the predicate question is, when I got into the industry, we were taking my first company public, ended up selling it instead, and Goldman told us that the average time to liquidity, inception to M&A was 5.5 years, inception to IPO was 7.8 years. It is now moving toward 14 years to build a category company. Yeah, and so the question is that secular? Now that's tracking 25 years there, or might AI disrupt and get us back to shorter liquidity cycles? Dave, do you mind starting?
Jesus. I don't think that's secular. I think that's as a result of venture actually kind of working, and people like Masa and other people raising shit tons of money to keep companies private that were previously public and growing at 50% or more for some portion of the time. Nowadays, we're trying to keep as much of that private until they're only growing at 30% when they go public. So I didn't realize it was 14. My last time stat that I heard was 11 or 12 years, but yeah, 15 sucks.
I have 12 approaching 14, but yeah, 12 is the last reported.
I don't think that time is going to change. The only thing that would possibly change that is not really AI, but more crypto solutions and fractional ownership. And you could argue private markets are sort of pretty liquid for companies that are large enough. It's just not very much information. So that's the problem. So I don't think that's likely to change, but Laura probably knows more about this.
I don't think it's going to change, because I think it's a structural issue people don't talk much about, but Frank and others know who follow capital markets that you had, when Cisco, NetApp, and others went public, they had nice $250 million market caps, they had maybe 25 to 30 million in revenue, and you had buyers who buy $2 million of the stock. You will not find those buyers today, or they are not going to come up to speed on a new name for $2 million. So you can't take a company public with that kind of market cap. Companies want to go public at least $1 billion and more like $2 because they don't want to be a small cap stock. So as a result, you have to have correspondingly very high revenue. That takes a very long time to build. So we are not going back to a market where it's going to take 7 years to get a company public, because it just takes a really long time to build to a revenue level that's going to support a multi-billion-dollar company. And then, of course, there are companies like Stripe that never want to go public.
No, I agree with Laura. I think it is structural. I think the technology sector broadly is attracting more and more capital from all over the globe. And it's just a simple matter of capital chasing returns. So if you look at technology as a percentage of S&P, dramatically changed over the last 10, 15 years. So it's only natural that capital will try to find their way to alpha. Right? So alpha is the technology, that's where the capital is going to go. So you're having more and more wealth creation happening in private markets, which is extending companies going public. And if a company can raise, Stripe, mentioned Stripe, we raised $7 billion last year in private money, why go public? Right? So that's the trend, that's the underlying cause for why this is happening in firms like ours, trying to build a business around that main premise.
I have a related question, if it's all right.
All right,
In light,
you get to, we'll do Q&A at the end, but you're special, you get to.
I like short-term.
just following
Oh,
up,
okay, fair.
in light of the fact that they can't, in some cases, don't go public, where's the exit? Like, how do you take your dollars and the shares and shares?
I'm so glad you teed up my segue. You segue, that's a perfect segue. So, I'm gonna frame it a little different. Yeah, I'm gonna frame it a little differently. So putting my allocator hat on, I'm at a lot of LP-only conferences, and everyone is crying lack of DPI, right? So as this, so structural change, longer hold periods for private companies, but funds are still written in 10-year lives. I specifically told the CIO at San Jose to plan on a 15-year distribution cycle, so we're okay. But everyone else is 10. Everyone wants their managers to clip off their best returns and create some secondary value for them. So the question I have for the panel is, what's the right role for secondaries to play in this new paradigm? And how do you help GPs and LPs? We'll go in reverse order. We'll let Raj go first this time.
Yeah, so I would say we, yeah, so there's absolutely a role for firms in the secondary space that are solving this problem of lack of liquidity or the extended liquidity cycle for most funds. And there's different firms addressing different pieces of this. So there's firms that are addressing just the LP portion. There's firms that are addressing the needs of employees, that are addressing the needs of existing smaller shareholders. If you're Sequoia, et cetera, maybe they don't care as much. But if you're a smaller firm with managing $100 million fund, you care more. So I would say, yes, this is being addressed. There's more and more firms now being launched to address this problem. So we started our firm 7 years ago, almost 8 years ago now. It was considered IAM, it's not big enough. And now the opposite is true. When we talk to our LPs, we just finished raising our third fund. The question wasn't, hey, is this big enough? The question was, all the big boys are coming into this now. How are you going to compete? So it's become a recognized need. It's become a need. The market needs these kinds of solutions. So there's more and more firms. But it's absolutely a problem, and it's a problem for foundations, endowments, family offices that kind of maybe got used to the older pace of liquidity or distributions, and now that's no longer.
Yeah, there are over 2,000 funds raised since 2018 that are 30 million or less. So those funds have pressure to distribute capital rather than just show markups to their limited partners, because a lot of those funds have small family offices, maybe their former colleagues from Facebook as limited partners. It's not really patient capital, and so there's real pressure, and that's a place where secondary funds can play, and not necessarily in taking out a whole fund, but at least for us, we only are interested in individual companies, and smaller funds are going to be forced to sell winners early or pieces of winners early to show the distributions. So that is one place that we play, as well as for employees who are seeking liquidity for any reason, from sending kids to college to divorce. So I think it's a place where secondary funds can play a big role. And there is certainly LP demand out there we're in discussions with the top 20 endowment, who's like, this is a great compliment to my venture stuff because we're not gonna be illiquid in your fund for 15 to 20 years.
They wish. Yes. I think this has become a really hot topic, it seems like, in the last 6 months. About 5 years ago, we got started, and secondary was boring as shit. Nobody really cared. All the other stuff was going up into the moon. Why do I want to sell? It's going up. 5 years later, we haven't had very many IPOs. In the last month, we've had some IPOs, yay. But not much in the last 3 years. So everybody's talking about it. A large number of people are talking about it from the context of the general partner of a fund selling to show performance, to generate DPI and returns. Hunter Walk had a great post on this 2 weeks ago. Yeah. Although there's lots of people writing about secondary all of a sudden. I think I would say, you know, it's the privileged few that have the opportunity to sell at a great price. And that's in a normal market, and in this market, that's even tougher. For direct secondaries, I think the stats are that like 3 or 4 companies make up over half of the capital volume of secondary directs, which is most of secondary. That's probably SpaceX, OpenAI, Anthropic, Anduril, maybe a few others, Strike probably, and a few others. There's a second group of maybe another 20 companies that are also pretty hot, interesting, and that's another 25% of the rest of the market. And then there's an extremely long tail of everything else, which are some great companies, but not the companies that everybody is hearing about. And if you're trying to get secondary in those companies and you're a seller, you're probably going to be facing 20 to 30% discounts in the direct secondary market. If you're looking at funds, which is a slightly different thing than selling individual shares in a company. If you're selling a fund position as an LP, you might want to get out of the fund before 15 to 20 years that it takes. There's really very limited buyers for most funds. And so, again, this tale of two markets is really about who has leverage in the situation. For these really big names, SpaceX, et cetera, it's a seller's market. They might even be selling at a premium to the last round. There'll probably be lots of people trying to push you into SPV vehicles, which have murky structure and fees and carry, and you may not know how many layers exist in those things, and lots of complicated dynamics where some of the companies don't want that to be happening. So I think most people are in a situation where they aren't in those companies, where they don't have a fund that's like 80, 90% SpaceX. And it's a much more difficult transaction for the seller in those areas. And so while everybody's sort of thinking, hey, secondary is going to solve my problems, and it does solve problems for a lot of people, for general partners of funds, I don't think it's going to solve that many of their problems. I mean, they will probably have to face, there's 2 or 3 very large elephants in the room for GPs. One is most people have not marked down their portfolios in the last 3 or 4 years. They're still holding companies at valuations from 20 and 21. Unless those companies have grown 3x in the last 3 years, they're probably not worth what they raised at. So that's a big issue for probably, I'm going to guess, 300 to 500 companies out of the 700 or so unicorns out there, maybe. Probably more than half have that issue. The other big issue is you probably, as a general partner, have a number of companies on your portfolio which are never going to get to an exit because they're too small or they're growing too slow. And that's probably at least 20, maybe 40% or more of some people's portfolios. And all of this is sort of getting to the situation that VCs are horrible liars, and I say that as one myself. 100%. And we're lying to our LPs and we're lying to ourselves about what the valuations are. And even if you reduce the valuation of your big winners to what's reasonable, and even if you wrote off the shit that's the long tail that's scattered in the public, you still have a portfolio that is illiquid. And if you are selling to someone for cash, you are going to have to sell that at a discount in funds that is probably at least 30, 40%, maybe 50 to 70%. I'm in the business of venture capital secondary. Isn't this so exciting? Isn't that optimistic? Well, if you're a buyer, yes. If you're a seller, it's a fucking pain in the ass. Okay,
I am gonna go, did you ever follow that?
I just wanted to say, I want to know two things. One, worst liars are private equity because those guys are getting away with continuation funds, which is something I don't even.
They have real companies with metrics.
I think sort of, that's a whole other two, this whole thing of like the SpaceX, SPVs of SPVs, I think whenever SpaceX exits, you're gonna find this is a producers kind of situation. There are people out there who think they own 10,000 shares of SpaceX who own 50, because there are so many SPVs of SPVs for some of these companies, it is really scary.
The first thing the partner at my first venture firm, founding partner, told me about venture capital is often sees lies, so I'm not gonna date on that. Okay, I've got plenty of questions. I have plenty more questions, and I also know the audience will have questions. I'm gonna try something. If you don't want to answer this or it's a bad question, it won't hurt my feelings. But I remember a Sequoia partner used to take me to breakfast very generously when I was early in my career. And he just explained the genius of Silicon Valley, which was, seed, Series A investors, 1 out of 10 companies hit, but they expected a 20x, all the way up to your growth investor right before IPO. Most of the companies would hit, but they were expecting a 2 to 3x. So like this very neat ecosystem for financing, project finance developed for venture-backed companies. And everyone kind of understands the risk reward of their trade. You talk to me a little bit about the risk reward when you think about the trade for buying LP interest or buying direct from employees. I don't know, anyone want to take that question? Because it's very interesting to me. This happened in 2012 and it's happening now. The trading price in the secondaries market the last 24 months for so one of my portfolio companies went public. All of those companies were trading at higher valuations in the private markets than their IPO price. And that happened 10 years ago too. So how do you think about avoiding those kinds of outcomes? Anyone want to go first?
Well, I'll explain our math. And I used to run an early stage firm, so the math was extremely different for 500 startups and a lot of early stage portfolios. Roughly, we would assume 70% of our investments would not return any money or would return less than $1. So probably like 40–50% would go to 0, 20–30% might return less than X. Another 20 to 25% return 2 to 5X. And then you make most of your money probably on about 10%, maybe more or less, that return 10 to 20X, and 2%, maybe 1, maybe 3% that do 50 to 100X. And hopefully those numbers sort of add up to, 3X gross, maybe 2 to 2.5X net. If you're really lucky, 4X gross, 3X net, which I would hope for, but that probably happens for very, very few funds. The one thing I will say is we also experience really crazy outliers, about 1 out of every 400 or 500 companies. So about 3 or 4 of those where they were 1000X outliers. Talk Desk originally, Canva later, GitLab maybe not quite 1000X for us anyway, and Solana. So 4 companies out of about 1800 had sort of these really, really huge outliers. If you look at YC's data, pretty similar around that. But most people don't have 500 companies, right? And so typically, most VCs are playing for, hey, am I going to get that 50, 100X winner, which happens 1, 2, 3% of the time in a portfolio of 30 companies. And 1 out of maybe 4 VCs gets that to happen and thinks they're a genius. But in general, that's the math, right? For secondaries, I would say we generally are trying not to lose money on not more than 20% of our investments. There might be some zeros, hopefully there's not too many of them. We try and make money probably on 2s, 3s, and 5s, right? And we might get some 10Xers that happen, but probably we are trying to generally aim for 3X in 5 years, which is roughly 25% net IRR. 2X in 5 years is okay, that's a 15% net IRR. So, sorry, 15% gross IRR. So trying to play within those ranges of 2s and 3s most of the time, not too many 1s and 0s, and maybe some 5s, maybe for lucky some 10s, but it's much lower multiples, lower risk as well, but really importantly, faster time horizon. Right? And so if we can get those 2s and 3s in 3 years, hey, that's a pretty good IRR.
Yeah.
And so that's really the game is.
So are the LPs all over you to get into that? That seems tough.
I guess I am raising our 3rd fund. Thank you very much, my friend. I will say that you have to be careful because you can make mistakes in this market. Valuations are definitely problematic. The first half of our 2nd fund, we were probably only buying at 30–40% discounts when we should be buying at 50–70%. So the 2nd half of that fund, we sort of adjusted our pricing a little bit more. And there will be a few zeros here and there. Like I do say that secondary investing is not for the faint of heart, and it's not for the part-timers unless it's a company or fund that you know. Probably want to diversify across at least 20 positions, maybe slightly more depending on your business.
I wanted to ask Laura a specific question about her fund, because someone mentioned data science here, and you and Tim are using data science to try to identify companies so that you can get them at the right price before they become frothy. So open-ended question, please say.
They may already be frothy because Tim's build technology focused on 3-year time horizon. So what are the companies we focus on Series C and later in sectors we understand. So that's enterprise broadly, AI, security, fintech. And then he's built sentiment engine. He also looks at characteristics of the CEO, centrality of investors, do a rank list. And the ranking sort of says, of the 2,500 companies that meet those, the criteria, Series C, US and Canada based, et cetera, here are the top 50 that are most likely to exit, in a 2-week time, this period of time. And these are the ones that are, if you will, a shopping list. And, what is it? And it's comparative versus the other 2,500. And Tim, when he was getting his PhD paper at the University of Chicago with program Chris Gatesy, who has his PhD in finance under Fama, his first hedge fund. So Tim's actually capable of doing back testing, unlike most people who've done data science in Silicon Valley. So he's back tested the results, and it turns out companies on his list of 50 are 3 times more likely to exit than a random group of 2,500. So that's before we added things like human diligence to see, like, is this a good company? Is it not? So for us, that's part of, because one of the questions in secondaries is, where do you focus? Because with 2,500 companies out there that at least fit our initial screen, that's important to us. And there are lots of other places one could apply data science to the secondary market, because unlike seed stage, where I really don't believe data science works, in spite of all the people who out there who think that does, there actually is enough data out there to give you an indication of the health, but this is not Citadel. We are not a bump on a wire where it's a thumbs up, thumbs down based on a data science approach.
I was going to ask you a different question, but based on what Mark was asking, you just closed the fund, and I had the privilege of sitting down with you and your partner last summer. And I know your numbers are good. I know you had a strong story, but I'm still curious what the LP universe was asking of the secondary fund.
Yeah, thank you. So we went from finish about 8 months, which this part market's supposed to be good. So but I think a couple of things resonated with the LP world. And I think performance is sort of table stakes. You have to have decent performance, and you do. But I think the thing that resonated is the things that we've heard over the last few minutes, which is the LP universe. And our LP universe is about 30-ish% family office, and the remaining traditional pension funds, foundations, and endowments. And the thing that we heard over and over again is that the LP world is looking for exposure to technology, which is all we do. So very, very focused on tech. They're looking for exposure to technology that doesn't have a 15-year distribution waiting period, and they're looking for decent results. So I think that's what helped us, and we've proven over background helps certainly, but we've proven over 2 funds that we've got good results, good companies, and we're kind of niche. We only do very, very late stage companies, or median revenue of our fund 2 portfolio is 400. So it's very, very good. So late stage, so we're really, at today's point, we can't have any zeros. We have to. For us, if it's a 1.5x, that's about it. So we're typically underwriting to low 30s IRR. So I think that helps. It's a very focused niche story. Our most recent fund is $300 million. I don't know if we could raise $1 billion with this strategy, but for our size, we're concentrated portfolio, $300 million fund. Portfolio construction wise, we do have 15 companies. So concentrated, high conviction bets, the best of the best.
Are you buying, like, the CFOs leading the employee purchases, or are you going directly to employees?
Yeah, so all of the above. So we start with the company first, usually to try to make the CFO our friend, and either lead a tender process the company's doing, or in some cases say, hey, make us your preferred sort of buyer for these one-off transactions. Some ex-founder, some employee who they really care about. So companies are more and more company CEOs, managing teams are more and more focused on trying to provide a solution to their key employees, because they recognize that these employees have an option to go to Meta or Google, where they actually have liquidity. So money, the stock should mean something for selling. So this is why you see Stripe doing these very sort of consistent. Canva's another one. They're doing very, very frequent, periodic tender offerings for their employees. Databricks did one, Stripe. It's become more and more common. So so we try to be a player in that market, either directly as part of the tender or sort of on the side.
Okay, any questions from the audience here? Because I see well, Mark's not here, so I guess we can keep. Oh, what'd you do? You go around the outside. Oh, okay, well, I gotta get somebody, okay, please.
My small opinion is, you guys have a really important job. Some of us feel like one of the biggest impediments to innovation is that the secondary market is not well developed. And so, I can go to Zoe here at Goldman Sachs and say, okay, I've got a bunch of LP positions in mega funds. Can you help me? And they can do that. I can go to a big mega fund and say, give me a SPV of your biggest companies. They can do that. But everyone else, there's no liquidity. And so if you're an entrepreneur, maybe you're an A or B type company, what do you do until you get some liquidity? You're just kind of in limbo until you get your capital so you can go out there and do your next thing. Or all these VCs are focused on big potential unicorns instead of, sufficient capital toward the singles, doubles, and triples. And so when is the secondary market going to be big enough to really be able to help out here?
Well, I hope never, because that means my returns will be good. The reason I sort of got interested in this business, I was originally thinking about doing a micro VC fund of funds platform, but I was also looking for liquidity in some of my earlier funds at 500, which had done well. And I thought, hey, I've got a bunch of winners. One of them's got Canva, the others were already at 1x. This should be easy. I was thinking about trying to, take $3-4 million off the table. Nobody wanted to talk to me for a transaction less than $5 million. Even though those portfolios looked great, I was still facing people, basically saying, hey, you'll have to sell this at a 30% discount and or give me additional asset coverage. And I was like, wow, this is a really shitty deal. I eventually increased the size of my transaction to about 9, got a deal done. Oh, this was maybe not the best deal. 2-3 years later, market crash. It's like, wow, that was a great deal. But I think, we are a little bit smaller fund where our current fund's about 55 million. We're raising for sort of that $50 to $100 million range. And we're focused on transactions typically less than $5 million, which is a lot of the market, but not really worth the time for an industry or a Stepstone, which has $1 billion funds. Probably not even worth the time for these guys who are into larger funds. So, people say secondary as if it's one thing, and it is 100 things. In fact, there are probably more strategies in the secondary market than there are in the primary market, with less than 1/10 the number of players. And I think in private equity, the entire secondary market is like 150 billion for a $3 or $4 trillion market. In venture, it's maybe 60, 70 billion, I believe industry's numbers, maybe a little bit more. For again, probably an overall $1 trillion or $2 size market. So it's single-digit percentages at best. And I don't see that change, even though there's lots of new people who are entering the secondary market as investors. Everybody's playing catch up on that. And there are marketplaces as well, EquityZ, Hive, and Forge. Free public service announcement. There is one big secondary market most of you have never heard of. It's called the IRS. How many of you have ever heard of 1-800-CARS-FOR-KIDS? 1-877-CARS-FOR-KIDS. Right. So you can donate your car and you can donate clothing, probably at slightly inflated values, and get a receipt from Goodwill or from whomever as a tax deduction. You can do the exact same thing with overvalued funds and companies. Oh, excuse me, did I say overvalued? Optimistically valued funds and companies by going to a specialist who will give you a third-party fair market value for those companies or funds. They'll probably discount it a little bit, but not as much as you would face as if you actually sold that.
So we happen to have such a person here.
Happen to have such a person here?
Not IRS, no, I don't work for IRS.
Well, anyway, what I was gonna suggest is, okay, let me finish my commercial before you do your commercial. The thing I was gonna say is you can donate to your own donor advised fund, right? And there are plenty of people who do this, not Fidelity and Schwab. University Impact is one that's operating out of Utah, Silicon Valley Community Foundation here, Impact Assets, there's probably several. So get a third party fair market value, probably at 80 to 90 cents on the dollar, donate it. You can use that tax deduction over 5 years. And the funds that you donate will go to a philanthropic asset that you kind of can direct to other things. It's not your money, but it is somewhat under your direction. If you're interested in that, let me know.
I already did it after getting my head breakfast.
And I have personally taken about $8 million in tax credits using that strategy.
So we're gonna sort of move on, unfortunately. We got one more question?
There was, $8 million tax credit, and now
Nobody in the IRS in the room, right?
at liquidity, actual dollars, if you were able to actually.
Well, that's tax credits that I hope to use probably on the Canada IPO, knock on wood. But if I'm wrong and those assets are worth more, hey, I have more money to give away, donate, that's philanthropic.
I was trying to bring in Ken's, talk about secondaries, but Ken's a big holder of Canva, I noticed.
Well, don't sell Canada. Well, you can sell to me, but Canada's doing great.
So did you want to go first?
No, he's good.
Is there a major downside, or risk, if you could be authentic and open, like if you raise a $300 million fund and it's all great today, but what's the downside? What's the risks here? I don't understand. It sounds all perfect. And
buy at the wrong price, stuff doesn't exit, you hope exits. Those are two major. They
The
don't
risk
grow.
is the same as in any investment, right? So either you're in the wrong asset or it's the wrong price. And that is true in secondary investment. So I think if you're investing at an early stage, you better be buying at a.
Yes, but I keep things really simple, Melanie, so I'm trying to understand, and lots of intelligent people in this room. I'm trying to say, if you're coming in very late with a secondary situation, then how are you getting your return? What are you waiting for? Is it because you're seeing a clear exit? Is it because it's a Warren Buffett approach where it just becomes a profitable company in dividends? How are you going to get that return?
Technology is very simple. You have, so when we underwrite, we're a late stage investor, we underwrite, number one criteria is, can I see an exit in 2 to 4 years? And that requires judgment, experience, etc. So Canada, right? That will be an exit. You can count on that being an exit. So if you can invest Canada at a reasonable price, you should. That's the business.
I would say it's a combination of the discount to true value that you're getting on the day that you purchase, plus the compounding.
Plus the compounding over the next couple of years, and the risk is, hopefully, it does exit, ideally via IPO or a large exit, possibly via a further secondary. And so we're probably trying to optimize for, hey, can we get effectively around a 20–40% discount to true value on day one, and can we get compounding at 20–40% over the next couple of years? If we can do that, we'll probably be in good shape as long as it exits. But there are many risks that upfront valuation could be wrong. The company's growth could decay. Shit could happen in the markets where there's no open window for IPO market. Hopefully that isn't the case. So lots of things can happen, even to large companies that are doing well and have provable revenue.
As you run a concentrated strategy, you worry about idiosyncratic risk, right? So one
What
company
about other
can tank.
funds coming into this? They see this and they want to like do what you're doing, and then they're gonna be like,
Well, that's why
Tiger
Dave said,
Trends
that's why
secondaries.
Dave said he hopes it doesn't ever, attract this much capital, right? Because we don't make money in an efficient market.
Eli's got a quick
Take a
question.
little while to figure it out too.
This is not the same as primary market investing. I did primary market investing for about 15–20 years. I've been doing this for maybe the last 5 years. Still learning and still make mistakes, so hopefully not too many.
Just to follow up to what Mark was saying, the Wall Street Journal had an article about 10 days ago. The Moody's raised the red flag that there's $120 billion in 2025 in the secondaries market. As a lot of private credit funds have basically dried up and they couldn't be able to find deals, they're moving toward secondary deals. How do you see that impacting the
And
price?
by the way, again, secondaries meaning what, right? Because it could be private equity, it could be real estate, it could be private credit, it could be venture, within venture, it could be direct or fund within either of those, could be early stage companies or later stage companies. So there's like, again,
Private credit funds are enormous. There is no way they're gonna go buy $1 million of some engineer's shares in Canva. They wouldn't know how to diligence it or access it.
Really,
Yeah, I don't see
There's
it.
lots of different sizes of customers. And lots of, you too can start a secondary fund. Just, you know, you can take a few years to figure it out.
Figure it out. But I don't wanna give you the hope, that's the thing. I know, I should have noted to the future. This is the
we didn't even get into forward contracts, conditional payouts, all kinds of other
We
structures.
should have a second